Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, here with our quarterly call, and it's been another crazy quarter. Everything from what's been going on at the banks to the markets, and we're seeing some things you'll see here in some of the themes we're noticing. One is that speculation has come back into the market. We thought it would really take care of itself in 22, but it didn't. We've seen that start to come back. Economic activity remains weak. We're going to show you a few things along that way. We're starting to see some opportunities in the bond market. We think that we're getting past the point of where you need to stay close in with all your bonds. By close in, I mean less than a year. And the last thing is that stocks are still expensive. We'll give you some information on that and sort of tell you where we are. But the big question is, can the Chairman Powell land this economy? Everybody talks about a soft landing, hard landing. We certainly don't believe in a no landing. But looking into that, if you look at the economy, we're going to start with a couple of things here. But if you'll notice, this is a Purchasing Managers Index, and if you look, it's for new orders and manufacturing. Those are both in recession territory. They keep declining, which is not positive for the economy. The Services Index, which came out today, also negative. And so we're starting to see things move in that direction, or continuing to move that direction. You'll also see jobless claims that moved higher. That's a slower thing in the economy because it comes later on. People hold their employees till the very end if they can before they let them go. We're starting to see a lot of layoffs, but that's a lagging indicator for us. You'll also notice you're starting to see in office space a couple of things going on. Number one, you'll notice the vacancy rate has gone a lot higher over this last 15 to 18 months. And secondly, we're starting to see the spread now break away. If you look at Class A property vacancies relative to B and C properties, B and C properties usually are going to get hit worse. During the period, people that have enough money to stay in an A property usually will. That's starting to show up in there. Secondly, one of the things we've noticed, people have asked us a lot of questions about it. We're not seeing as much weakness as we thought we would in the housing market. We think that's been delayed for this reason. If you look at the amount of equity that people had built up because of this extreme surge in liquidity that bid up all the real estate for people's homes, you're much higher than you were back in the 05, 06 area. So you've got a lot of room to squeeze that back down relative to where the debt levels are. But the biggest reason you'll see here is that when you've got all of these mortgages under 4% on the mortgage side, and a lot of them at 2.5 or 3, you're going to see that 72% of these loans are in that category. Then people are going to do as much as they can to try not to move anything if possible. Now, eventually, it catches up because they have to move for various reasons, and it's slower to come around, but it eventually creates supply as you go along. So we're looking for that as we go along. I printed some things here just so you can see some items that I think you'll find interesting as far as knowledge for you. And I could give you really 10 more of these, but if you look at these, really, if you look at manufacturing down, you'll look at car payments, for example, the greatest number we've ever had for people paying over $1,000 a month on their car payment. Another stat you might not know is that it takes, to buy a car today is 44 weeks worth of pay. That's gone up from 33 weeks just 1 year ago. So we're starting to see those kinds of things. Inventories, the same way, residential construction. All of these things, if you take a look at them, point to the economy continuing to go slower. So we're a bit confused on people that think, hey, we're all in play here, ready to go, and all we're doing is waiting on the Fed, because that's not what we're seeing at that point. So what happens in the bond market? The biggest thing that's happened is this, and this probably would catch you by surprise, but if you look at the U.S. Treasury yield curve in 1st of January, you'll notice, obviously, the rates in the short term were higher, but they moved higher since that time because of the Fed. And that's happened while the 20-year and the 30-year, I want you to look closely at that, those numbers have declined. Now, this is the spot in the bond market that's really hard for most people to think about, because I've been here before where the short rates are really high and the long rates are not as high. So it's a contraindicator, and it's hard for you to go against the grain, but that's what you have to do prior to going into a recession. You're going to have to step out and buy some longer paper, because all of a sudden the short rates, when they start down, they'll really start down. And it could be a year from now or whatever, but this is one of the best charts I can give you from my friend David Rosenberg. But you'll notice, when do you buy stocks and when do you buy bonds in a recession? Now, if you look at the right-hand side, you're going to see you start buying bonds, the rates start down well before the real recession numbers hit. And you buy all the way through the recession, because the Fed's going to keep on lowering and lowering and lowering, and they'll even lower too much after the recession. So you'll see those rates come down and down and down. Now on the stock side, totally different game. You'll see the time to start with stocks is at the bottom of the recession, when basically everybody has given up. And we've been there numerous times when they throw in the towel and they're like, hey, you know what, we can't do anything. So that's where we are on those. If you look at the stock market, I'm just going to give you one idea of the speculative nature. This ad you see on top here has run every single week in Investors Daily, which prints every Monday delivery. They print it every week, either a half a page or a page. If you give us $100,000, we'll produce anywhere from $5,000 to $8,000 a month now, okay? So that, just run the numbers on it if you would, and we're looking at 100% return. Secondly, lower graph, you'll see, if you go look at all of the ARC funds, which I think there's probably, 7 or 8 of them, they're all the same, okay? They peaked in the first quarter of 21, and they're all down about 75% since that time. And yet, people keep driving money into this area, thinking it's the new paradigm, it's the new paradigm. You know, the last time I heard that word? 2000. In the first quarter of 2000, I probably heard new paradigm at least 15 or 20 times when I talk to people. And that's the same way we're seeing in this kind of thing. But why would you keep driving in if you've lost so much money? That's the speculative side. The other speculative side is this graph, which shows that everybody's been trying to buy these markets down. I'm using the NASDAQ average now, okay? And every time you get a high, they get excited and want to come in, just like they've done here the last 2 weeks. They come in, they want to get excited, they want to buy it. It's not the time. You know, the prices are still high, but just notice this though. If you took the top 10 or 11 stocks out of the market, out of the S&P 500, S&P 500 would be negative for the year. Just to give you an example, these 3 stocks, okay, Apple, Nvidia, and Microsoft, make up 91% of the gain in the first quarter. 91. They're all stacked up in one spot, which is usually not good for the market. The other thing we're seeing is that obviously we're not into a low point on the margins for our public companies. They're coming down, but they've got further to go. And as those go down, what happens is the earnings are going to come down. You'll notice the street's been lowering their earnings expectations here. We're down to now around 222, 223. That's actually too high. We really think that's going to come in, 195 to 200. We'll see, may not, but if that does happen, the market's overpriced. One of the other things, we put this in the market letter that have just come out in the last few days, is that the price to sales of the market, the S&P, was about 2.2 at the high in the dot-com bubble, okay, and that was expensive. It got up to about 3.3 times this time around, because we're in a bigger bubble now than we were then. This time around, everything was in a bubble. It didn't make any difference what it was. Stocks, bonds, real estate, businesses, crypto, NFT, all of it was jammed in together. So it takes a long time to wring it out. Now we're only still now back to 2.2 times the high in the dot-com bubble. And the other thing here, we don't know they'll play out this way this year, but if you go back to 1945, the last 6 months of the third year of a presidential term is not very good, actually. We'll see if that works this year. It may or may not work. We think it's going to tie right into what's happening in general. And the last thing we'll say is have you a long-term chart of gold here. And one of the things we have is this. Just to give you an idea of our 3 strategies, We own gold in our conservative income strategy straight up. In high income, we own the gold and the miners, and in the stock accounts, we own just the miners. Those look good to us still. And one of the things you'll have to remember, typically, as bond rates go down, gold prices will go up. So that's sort of where we're looking at the whole package, and that's why you'll see that we're continuing to stay conservative in the portfolios. So to wrap it up, I'll just give you an idea that volatility is really here, okay? You're going to see more of it in the stock market. Bond market volatility is unbelievable. I've never seen, since I've been buying bonds, what we're seeing now from a day-to-day basis of volatility in the rates of the bond market. They're all over the place. Stocks the same way, same way as far as they're moving around. And then on the Treasury side, we're maintaining Treasuries. I will tell you this though, in the opportunity side of it, we're seeing a few things we're buying on the stock side, but in the bond side, the opportunity for us is we've stepped out, okay? We've nailed down 2-year yields. We've also, obviously, will take down some 20 and 30-year yields because you're going to have an offset if they keep on driving these rates when they eventually get scared and drive the short rates down. Something to keep in mind. The other thing in here, we really feel like we're at an inflection point is patience. And as we said in our letter, you have to give it some time. But the only thing that would change our mind right now would be something from the outside, like the Fed coming in and saying, hey, we're going to really juice the system, we're going to put a lot of money in the system, something that would recreate a huge demand, which we're not seeing right now for the stock market. So as we go forward, hopefully this is giving you an idea of how we're structured going into this second and third quarter. So if you would, if you want more information, you certainly read our letter that just came out. And if you want a lot more information, you can come and visit us at the website, oxbowadvisors.com. And I want to thank you for listening in, and we'll see you next time. Hello everyone, I just want to say if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.